and mortality is in the favor of the insurance company, which hopefully that's what we all want. Like, I don't want to be paid on Robin's policy, but if things happen, she needs to get paid on mine and I need to get paid on hers, right? So,
Need some advice, never sacrifice, always get it right. Ask the Planman. Finance, insurance, and more.
hi, everybody. Welcome back to Ask the Planman. I'm your host, Bruce Weinstein. I believe each and every one of us needs to have some planning in our lives. Today, we're going to talk about the different uses of life insurance. We're going to tie in the conversion features, but I want to break down with you some of the components with life insurance of not just your normal protect your mortgage, protect your kids' education, your survivor income, but where people can use it in more sophisticated manners. So there's things like buy-sell agreements in the business world. In our previous episodes, Ali, we've talked about using life insurance to create private pensions where you generate tax-free income for our clients. But buy-sell agreements and key man or key person insurance is very popular in the workspace, where you'll see big business, whether it's corporate America or just small businesses, where they have a relationship with a partner. And so the fundamental, let's start with buy-sell, is if Glenn and I are in business together, that's her husband, everybody. If Glenn and I are in business together and we're partners, if something were to happen to one of us, they need the ability and liquidity to buy out the surviving spouse. Meaning, I don't want Allie to suddenly be my new partner. I need equity to buy Allie's shares that she, quote unquote, has inherited from Glenn because of his passing. And so then I'm able to assume full control of the company. And so obviously we have a partner's agreement to execute that ahead of time. And then the funding is what's in question. Is where do we get the money? What's the value of the business? What's each partner's share? What's agreed upon exit? So that if I need $5 million to buy Glenn's position out of the company, I'd then have the full control of the company and I'd write you a check for the $5 million and you move on and do your thing. But I now have the company's control and obviously the reverse, so that Glenn would pick up my shares, buy out Robin, and have the company. So you have a buy-sell agreement written by attorneys, and then you have to fund it in the sense of how do I execute and fund it when it happens? And that's where people will use life insurance. Next, you have key person, key man insurance. If I have a high earner in the company, if I have somebody that is very strong in the operational side of the business and they were to pass, and key person is used for disability as well as life. So if they're disabled, well, I got to pay them and I have to go hire somebody else to take their workload while they're on that disability. If they pass, well, now I need to be able to hire somebody else in that position. So key man, maybe more for disability than the death side, because you're just going to necessarily hire somebody else in that regard, but you could use it for key person. Additionally, you have estate planning techniques. We may have touched on this in some of our episodes. We're having an episode coming up with another estate planning attorney. We'll get into that with her as well. But from an estate planning standpoint, you have to do some sophisticated work with attorneys and trusts, and you could use life insurance. Again, life insurance is to help create liquidity at the event. And so you're funding a policy in an irrevocable life insurance trust. Again, we won't get into all those nuances and nitty gritty. And so when that person and or spouse pass, it triggers the life insurance, which then drops a lump sum into the trust. There's no taxation on life insurance. There's no taxation because it's in the trust. And so then the heirs have access and rights to that trust and use it to pay estate taxes or, again, provide liquidity for the estate. So if somebody's very heavily invested in real estate, they're not forced, the heirs are not forced to sell off properties. Usually there's a length of time in there. The government's going to want their pound of flesh. There's taxes due, inheritance tax and the like. So the life insurance is very, very strongly used in that space. I'll also tie in that a lot of people don't realize, and I'm not super verse on it, but a majority of the banking industry, a lot of how they do what they do in securing assets and getting the deposit ratios, and a lot of people don't realize this, is they use life insurance. They fund big life insurance policies on their key executives. They used to say, the joke is that's why there's so many vice presidents in banks, because once somebody got to vice president status, they were eligible to then have an insurable interest for the bank to buy life insurance on them. And so they're funding and overfunding these life insurance policies, these whole life policies, to have more assets in their reserves, and ties in. And of course, there's leverage with life insurance and all of that. So, there's this lot of these tricks that go on that people don't realize what a behemoth the life insurance world truly is, and why the insurance industry is as large as it is. One of the techniques that people use are viatical sales, although somewhat outlawed, if you will. But back, 15, 20 years ago, you could go to these seminars by insurance agents, and they would show you how you would buy a life insurance policy, wait a year or two, get it funded, and then you could resell it in the open market. And so eventually the government cracked down on that sales practice. But if somebody has existing life insurance out there that they truly don't need anymore, or they can't afford anymore, their situation has changed, there's a market. It might be a gray market, but there's a market out there. I have contacts that I could work through if somebody needed to sell a policy. But it's somewhat frowned upon these days of soliciting for the sole intent of a viatical sale. And then, again, we may have mentioned in previous episodes, you have premium financing. And premium financing, again, is a very sophisticated tool, usually higher net worth. A lot of people don't want to spend $2, $3, $4 million a year on premiums. They can pledge assets. A third party will put the money up. There's a calculation involved. They get interest. You put up a bond. But at the end of the day, you're paying pennies on the dollar towards those premiums. And then in, let's say, a 10-year window, they get paid back. You get left with the net sale, and the policy is funded, but you put very, very little money into it. And again, it's a sophisticated tool. There has been conversation of it being disallowed. It hasn't kicked in yet, so I know it's still available out there. And we presented it to a few clients, based on their situations. And it's a long game. It's not a quick process, but could be very lucrative for an agent. It's a big ticket. It's a very large ticket business in that regard. So, the other components we wanted to talk about were some of the features in life insurance, such as waiver of premium. You can add, it's not very expensive, to your life insurance policy, what's called a waiver of premium. And that's if somebody were to get disabled. So that if something happens to them where they're now formally disabled, they don't have to pay their life insurance premium anymore. Now, that might cost them $50, $75, $100 additionally a year on the policy, depending on how much they're buying, what type of policy they're buying. But again, if somebody doesn't have disability, or doesn't have enough disability, or can't get disability, they could get life insurance and may not be able to get disability. Then this might be a way for them to protect. If you got a $5,000 a year premium on your life insurance, or 10 or 20,000, and you're disabled, it'd be nice to not have that payment anymore. I think the last component is understanding conversion a little bit more. I want to maybe explain some of that to our listener today. And that's usually done in the world of term insurance. Term is not permanent, right? It has a certain amount of time. It's finite, let's say 20 years. And let's make sure we mention them, Allie, is not every policy is guaranteed to have a conversion feature. So you want to make sure, if that's of interest to you, might cost you a couple extra dollars than a non-convertible policy. But what it basically does is it gives you that wild card option if you decide at the end of your 20 years that you might need some, if not all of your insurance, you have the ability, guaranteed, to convert it to a permanent policy. So if I'm 40 and I got a 20-year policy and now I'm pushing 60, I'm going to have two choices. The insurance company is going to offer me an annual renewable price, which is what I was starting to share with you offline. So let's start with that. So 2 years ago, my wife's policy was coming up. She had a 20-year policy, and we're paying $500 a year for her policy. Very inexpensive for a 35-year-old, whatever she was at the time, in her early mid-30s. And now the new rate is $4,000. That's not converted. That's just for that policy based upon her age for a 1 year of coverage. And so when a term policy ends, it can become an annual renewable policy. And if you look at your terms and agreements and declaration pages of your life policy, it'll show you the premiums projected after the 10 or 20 year window. So you know exactly what you're walking into. If you want to keep it, it's $4,000 and $4,200 and $4,400, and it's only going to keep going higher. So that's her first choice is she could just pay the $4,000. B, she could explore converting it to a permanent policy. You'd have to think if it's $4,000 just for the term, it's going to be that much more to make it permanent for that 60-year-old. Now, why is that being done? Well, these are guaranteed issue. They're guaranteed to convert. So if somebody was in ill health during that period of time that they had the policy and they find themselves no longer insurable, then converting is going to be a very smart option for them to keep the policy. So if I had a cancer diagnosis, right, God forbid, and I'm being given 2 years to live and my policy is running out in 6 months, well, unless they let me cash out the policy early because I have a terminal illness, which could be an option. So I guess we could throw that one in there, is some policies will allow that early cash out if you're terminally ill. That would have to be pretty strongly documented. But I want to convert it at that point because I know my time might not be guaranteed, and it's a short game at that point. If I feel like I have I've been given a shorter lifespan at that point. So I would want to convert it. But if I had diabetes, if I'd had a stroke, or, nothing that's terminal, but now I'm uninsurable, same thing. I would probably want to keep that policy and convert it. So convertible policies, you're going to pay as if you were a 60-year-old, if you're 60, whatever your age is, as a permanent policy. So now the trick of that, from my vantage point, is, well, let's try and get you new coverage first. And so in my wife's case, we got her twice the coverage for less than half the price of a new policy versus just taking the 1 year renewal. So instead of $4,000, I got her policy for $2,000 and I doubled her coverage. So that certainly was a win. Now, if she was uninsurable, I'm going to have to decide whether to drop the coverage, pay the $4,000, or maybe explore converting it. So our first step was, so I've got a client who, unfortunately, he's in his late 40s at this point. He's been a client for a long time. His policy is also coming up, and we applied for new coverage last year, and he got declined. Now, HIPAA protects him, so they don't necessarily tell me. He may tell me, but I don't really know what happens in that situation, why they were declined. They'll kind of tell me, could be high blood pressure, could be his blood work, could be diabetes. So they don't necessarily disclose it. But obviously, he knew and I knew that he was declined. His policy is convertible, and we'll be converting that in the fall of this year, and he'll just keep what he has. Now, then the decision is, let's say he has $500,000. Does he want to convert the whole thing? Does he want to convert part of it? And so again, we'll have to do some, planning work on his needs and the costs and his budget, and ultimately determine how much of that to convert. So you don't have to convert the whole thing. There usually could be a minimum amount, and then anything between that minimum and what the policy limit is, you can usually convert. So that's questions on any of that, young lady?
The only question that really popped up for me is a high-level overview, perhaps, of term versus whole life insurance, because I know that's a big debate. And I know I personally have been told on more than one occasion to not get term insurance because it's not worth it. So, yeah, maybe just a quick high-level run-through of that great debate of term versus whole.
Yeah. I grew up from the Wall Street days where it was buy term and invest the difference, because we were more of money managers than insurance agents. So the invest the difference was, they would buy stocks, bonds, and mutual funds, and we'd manage their money, and they would potentially make more. Permanent insurance, again, I think like anything else out there, it's an issue of needs and the conversation of diversification, diversifying the risk. So let's be clear. Term insurance expires 97% of the time, never pays. They only pay 3% of the time. Well, why is that? Well, usually it's done with a younger audience, and mortality is in the favor of the insurance company, which hopefully that's what we all want. Like, I don't want to be paid on Robin's policy, but if things happen, she needs to get paid on mine and I need to get paid on hers, right? So there's reasons you have it. The question is, what's your affordability and why? So are you truly wasting your money on term insurance? I mean, anything in the world of insurance, you could say you're wasting if you've never put in a claim, right? I've been driving for 43 years, paying thousands of dollars in my auto insurance with relatively little claims, knock wood. Did I waste that money? Is that a bad investment? Like, you can't, I have a trouble when somebody says it's not a good decision to buy term. It's very affordable. And when you have a young family on a limited budget, it at least helps fill the gap for that 2-year-old and newborn. And if something happens, the family's not displaced and losing their home, and college money could be put aside. And, as I said, Robin had a $500,000 policy for $500 a year. That same policy as a whole life policy could have been $3,000 or $4,000. It's a big difference. So whole life, again, I'm more from the camp of universal life, guaranteed universal life. Whole life tends to be more offered through what I would call the career life insurance agent route. I'm not saying it's bad. It's just a little bit different. They have a different point of view. Whole life pays dividends, which is in a sense interest. The dividends are in a form of unused premium, meaning there's money left over. Money comes in, money goes out for claims. And if the claim, there's not more claims than what they collected, they return it in a dividend. I mean, that's the essence of what a dividend is. So you have interest on your money, and then you have dividends. So if their clientele didn't die, then the money in reserves gets potentially a portion of it redistributed back. And those dividends, in a lot of cases, the agents will do more paid up insurance. They'll take the dividend and buy them another $2,000 of insurance. Well, that generates another commission for the agent. So, whole life is a steady eddy. If you think of it, the way whole life was structured at its core was by age 100, it would be all your own money and the policy would endow. And so part of your problem in calculations in all this world of life insurance is to make sure that clients are not overfunding their life insurance and not creating modified endowment contracts, MECs. If you MEC, you lose all the tax favoritism that ties in with life insurance. So you have to be careful the policies don't MEC out. So you can't overfund it beyond certain levels. And so a whole life policy was designed you pay in this amount, you get this dividend, this interest, and by age 100, you'd have your $100,000 of death benefit now in the equivalent of cash, and you'd get a check for $100,000. So I used to reference George Burns. I'm sure the majority of people listening have no idea who George Burns is anymore, but George Burns was a comedian that lived to 100. And I used to reference all the time when he blew out those candles, he got handed all his whole life policy checks because the policies endowed. They were done. Like that was it. He won. Now, if he died at 90, he gets a little bit less, he still gets the death benefit, but his cash value is slowly climbing to the 100,000. So I would draw kind of a grid, and as you go up and you're drawing that line to the grid, there's $0 in cash value on the bottom left end of the quadrant, and as you're moving up over time, there's more and more cash value being built. So there's less life insurance and more cash value. So we're using 100,000. So at some point, there'll be 30,000 of cash value, 40,000 of cash value. The death benefit, in theory, is still the 100,000. But what's the actual amount of insurance that they're covering or paying for? Well, they're only paying for 70,000 and 60,000 and 50,000. So as the client's getting older, the cost of insurance is going up, but we're also reducing the amount of insurance because the cash value is filling in that gap. And so that's how it's designed. That's the whole feature of what permanent insurance does, is you're accumulating cash value to alleviate the pressure on the rising cost insurance as that person's getting older. So what it costs a 30-year-old is different than what it costs a 60-year-old, right? Cost of insurance is that much higher, which is in the term insurance calculations. So it's kind of like, here's the price of term, here's the cash we want to accumulate, we're putting the two together, and then we're creating this way to provide the cash value. So if somebody's using it as an investment vehicle, at 90, George Burns could have said, hey, I got $95,000 in here. I don't want the life insurance anymore. I only have $5,000 of actual life insurance left. It's all cash value. I can take it out. So, people use it in different ways. Now, when you get into universal life, they're structured to survive. They're not necessarily structured to endow like whole life would be. But you want to make sure that it's funded strong enough to never lapse, right? You don't want a 92-year-old all of a sudden being out of money in the policy. And this has happened. When the dot-com bubble burst in 2001, a lot of variable universal lives got clobbered. The equity in the accounts dropped 40%. And so now all of a sudden, if you're 40% underwater in your life insurance policy, it's not earning what you need, you're underfunded, you're going to get a phone call from your agent and the insurance company, knock, knock, we need another $3,000. Well, what do you mean? Well, because you were projected to earn this and you didn't. So whole life is guaranteed interest. There's usually a minimum. Used to be 4%. I think years back they dropped it to 3%, but I'm sure a lot of them are back to 4%. I don't do whole life, so I couldn't tell you offhand what the current rates are. And then you have indexed universal life, guaranteed universal life. And so to me, these are hybrid products now where there's less focus on the cash value accumulation. And it's a guaranteed universal life to me is like a term policy where you pay a little bit more without having to build up massive amounts of cash value. And it's just structured to survive to age 110, 120 even, 110, 120 years of age, but not putting boatloads of money in, just paying premiums. So, your rates are going to be structured as you're older, cost of insurance is high, but there's no cash value to offset it. So it works a little bit differently. But it's, again, more advantageous. The bottom line to all of this, folks, is what are you trying to accomplish? Right? You know, my standard answer to any question is it depends. So what are you trying to accomplish? What's the best vehicle to get you there? Is it a plane? Is it a train? Is it a bus? Right? Like, what's the best vehicle? So if term gets it done, then buy term. If you need a permanent policy solution, if you need a cash value solution, if you need overfunding, if you need liquidity, like all of those components come into play of now let's match up the best solution for that situation. So somebody's looking for tax-free retirement income, overfund an IUL, you get upside growth, downside protection to the principal, get modest returns. At the end of so many years, you pull out money tax-free. On we go. Does that help?
Yeah, no, that answers the question.
All right. And I'm going to bring us home because we're right around our half-hour mark. So we're trying to do a better job of keeping these short and sweet for you guys so you can work your treadmill and do your laps around the house. But this has been another episode of Ask the Planman. Everything you want to know about insurance, finance, and more. Please like, share, subscribe. I think it's a powerful episode here. Everybody out there probably needs or has needed life insurance in their life. Maybe they don't understand how it works. Feel free to share this episode with them. Hit me up at 844-PLANMAN. Go to planman.tv. We're on all the podcast channels. And until next time, folks, if you need some advice, always get it right. Come ask the Plan Man. I'm your host, Bruce Weinstein. We'll see you next time.
When you need some advice, never sacrifice, always get it right. Ask the Planman. Finance, insurance, and more.